Hello everybody, welcome back to my channel where we talk all things finance and investing. Today's video, I'm going to talk a little bit about my own portfolio. The end of 2024 and the beginning of 2025, I've had a lot of clients, colleagues, friends and otherwise ask what's in my portfolio for 2025. So that's going to be the subject of today's video, my portfolio, which is actually a one fund portfolio only, and why I've chosen to do that. All right, let's get into it. All right, so as mentioned, I've had a lot of conversations recently. Some of them have been from the comments on this channel asking me what's in my portfolio for 2025. And over the years, when clients or friends, family members or whatnot have asked me, they've always been shocked to hear that I only have one fund in my portfolio, expecting it would be something very complex, maybe some derivatives and all sorts of things going on, given that I've worked in the markets for around 20 years. And in fact, having worked in the markets for that length of time, I have come to the conclusion that the best bet is really just to keep it simple, sort of that Warren Buffett style of advice. And I've taken that to heart and gone with that for my own investments. So what are some of the benefits of a one fund portfolio? Well, the main benefit obviously is simplicity. Going into the markets can be very confusing. There is so much news, so much analysis that happens every day, so much noise that I've seen so many investors just get too confused, find it too complex, too complicated, and they end up actually leaving the markets entirely, which is a terrible thing to do. So in my view, keeping it simple, like most things in life, is the way to go, and a one fund portfolio definitely does that. In fact, back in the day when I used to have several different funds in my portfolio, I found it way more stressful. And in all honesty, my returns were less than when I went to a one fund portfolio. There's more transaction fees, there's more costs, there's just more things to think about, switching in and out of funds when trying to time it. All of this sort of stuff just leads to stress and more complexity that's needed when it comes to your investment portfolio. And since I dragged it down to just go into one fund, and it's been around 6 or 7 years now, then it's gotten so much more simple and my results have been much, much better. Another thing, a lot of people who have multiple funds in their portfolio, and it does make them feel a little bit more secure and more diversified. But the reality is, with a lot of portfolios that I've seen in my day-to-day over the last 20 years, there's an awful lot of overlap in the stocks that they're invested in. They may be buying an S&P 500 fund, a NASDAQ fund, perhaps an all-country world fund, not realizing that a lot of those funds contain the same stocks in similar weightings. So they're heavily exposed to US, for example, thinking that by owning a MSCI World, for example, they had many other countries that they were invested in. But I see this all the time. A lot of overlap on the different stocks in each and every fund. So therefore, it kind of defeats the purpose of having many funds in your portfolio. So what is the one fund that I'm invested in? Well, if you've watched this channel and some of my other videos in the past, you probably know I like to keep it simple, and I'm a big believer in the S&P 500. There's a few different reasons for that. One, of course, is quite obvious. There's so many great companies that have come out of America over the last few years. The technological revolution is going strong. And with the access to capital and the innovation that we're seeing over there, some of the greatest companies have been born. Some might say the greatest companies that have ever been invented have come out of the US. So I just keep it simple, and I actually go with an S&P 500 exchange traded fund, an ETF. Now, since I'm based in the UK and GBP sterling is the main currency that I deal in, I deal in a GBP-based ETF. GSPX is the ticker, trades on London. But the thing about this fund that's a little bit different than the others is it's actually hedged against the dollar. Okay, so what that means is when the fund goes and buys stock in US dollars, as it would need to do to invest in the US stock market, it actually takes on foreign currency contracts to hedge or reduce the risk exposure of the pound versus the dollar movements. A lot of people don't realize, but if you're in a currency like GBP, euros, Canadian dollars, Australian dollars, whatever, and you invest in an S&P 500 that isn't hedged, you have an additional risk in addition to the stock market and that is the currency movements. Because if the dollar were to strengthen or weaken versus the pound, then the value of your fund will go up and down accordingly. So by buying the hedged version like I do, I'm reducing that entirely. Now, that has gone against me over the last few years because the pound has been so weak, really back to 2016. But that's okay with me. I'd rather just reduce the currency movements and the risk of that in my portfolio. Perhaps if I could do it all over again and start over, maybe I wouldn't do it, knowing obviously the pound's weakness, of course, but the reality is you just never know. FX markets are incredibly difficult to try and predict. So I stick with the hedge version. I don't need to worry about the pound and dollar movement, and I know I'm going to get the return of the S&P 500 only, and I'm just fine with that. Now, the fund I use that I mentioned, GSPX, is actually a distributing fund. So what does that mean? Well, the fund itself will pay the dividends that are received by the underlying stocks that make up the fund, the S&P 500, the largest 500 companies in the US stock market. They distribute that out in a dividend. It gets paid twice a year, and then I have that automatically reinvested. And you must do this if you're investing for the long term, because reinvesting the dividends will have a great increase in your portfolio value over time. So make sure you're reinvesting the dividends. You can also choose an ETF or index fund or whatever that will be an accumulating fund. And when the dividend is received by the fund manager, they just adjust the price of the fund itself upwards to reflect the dividend. So it's actually no worse off. The dividend you're still receiving, but you're receiving it through the value of the fund. I prefer to have the distributing. I like to see the dividend being paid. I think there's additional transparency there, and I just like seeing it hit my account and get reinvested in. So that's why I use this fund as well. It is a distributing fund. So why not use something like a world fund, which actually tracks more than just the US and the S&P 500. A lot of people tend to prefer MSCI World or the All Country World Index. And the fact of the matter is, when I've looked at them, and I have looked at them many times, you kind of lose around 2% per year in returns. If I look at the last 5 years, that's what it's turned out to be. It includes many of the big names in the European markets and some in Asia and places like Japan. And unfortunately, some of the returns in those areas have been less than they have been in the US. A lot of that comes down to things like regulation, government policies around growing the economies, and those economies just haven't grown as much as the US market does. So for myself, I'm happy just to have the 500 largest companies in America and not give up a couple of percent per year in returns by including some other big companies that are found around the world. That's just my personal preference. Another reason why I'm not bothered about being just in the S&P 500 versus international funds is when you look at some data by FactSet, you'll see that actually 42% of the revenues of the S&P 500 come from outside of the US. These companies have exposures all over the world. So they're very well-run companies. They're making money and bringing in revenues from basically all corners of the globe. So I'm happy with that, and that gives me enough exposure to the global economy. Remember, when the US economy and stock market sells off, a lot of the other major developed markets sell off just the same amount as the US does. So therefore, I don't feel I'm really gaining much by being invested outside the US. And that is why I stick with the S&P 500 one fund portfolio. Okay, so what else is in my portfolio? I said just one fund, but the reality is I actually have around 10% of cash. That's it, 10%. And what I do is I keep that there for when the market sells off. Now, sometimes I'll take that and I'll buy a short-dated government bond if I'm pretty sure I'm going to be holding that cash for a year period. But heading into 2025, I'm happy to have this set on cash for now. Why? Because I believe probably at some point in 2025, the market will sell off by about 10%. I don't know this, it's impossible to time it, but I like to have that peace of mind. And what I do, and I've always kind of done this, is if the market sells off by 10%, and that is a correction, I will automatically take a chunk of that 10% cash that I have and buy back into the market at that point. Depending on how far I think the market is going to fall, I might just take, say, half of that 10% and put it in, or maybe a bit less. And I will just keep doing that along the way. If the market comes down 20%, I'll pretty much get rid of that whole 10% cash. In that case, I'll be fully invested, and then I'll just ride it out from there. Now, usually at the beginning of the year, I'll also rebalance a little bit. So, for example, I finished 2024 with around 12% cash. So what I decided to do, there was a period around Christmas where the market had sold off around 5 days in a row. I took that extra 2% and I just bought back into the S&P. So I started the year off around 10% in cash and 90% invested. And that's pretty much where my portfolio sits right now. By the way, if you're wondering, I've got many people that I know who've been working in investment banks, top tier investment banks, and had top tier jobs at these places. I mean, they've risen to the top nearly. And a lot of those people use the exact same strategy that I've just outlined on this video. So if you're sat at home watching this video, a little bit confused about where to put your money, what to do for 2025, and all of this sort of stuff, you can take some peace of mind that if you employ this strategy, and that's entirely up to you in your own circumstances, but you're doing so along with many people who've got many, many years experience in this business themselves and know the markets extremely well. An S&P 500 at 90%, cash at 10, rebalance if the market sells off or in and around the end of the year. Trust me, a lot of people who've got a lot of years experience do this strategy as well. So that's my video on my one fund portfolio. Very simple. As I say, 90% S&P 500, 10% cash, and maybe some rebalancing during the year if the market sells off. Super simple. If you like the video, why not leave me a like? Subscribe to my channel if you haven't done so already. A lot of you viewers aren't subscribed, and subscribing really helps me produce content like this. So I really appreciate it if you could hit that subscribe button. I'll put a link in the comment section down there. Just click on that and subscribe to my channel. And let me know in the comment section what you thought, what your portfolio is looking like, what you think of this strategy that I employ year after year. I don't try and chase the markets and chase different geographical locations. I just stick with this plan. So let me know what you think about that or anything else that you want to hear on my channel. And as always, all the best in your saving and investment journey.